Hi, I'm Matthew Lester of the Rhodes Business School. I'm doing a review of the UNISA Tax examinations for 2011 as updated for the tax amendments in 2012. In this video we are looking at question 4. It was a 50 marker with a 75-minute allowance. This question consists of 6 parts. All taxpayers are South African residents. You can ignore the VAT implications in each question. I like these type of questions. They give a wide scope of coverage of the Income Tax Act and they are very good for revision. Let's start off with part A. Let's read the question. It's a 12 marker. You've got 18 minutes and immediately they talk about Mrs. Scaly, so we know that we are involved in some fraud and a bit of fun there. She is a diamond dealer. Further information that we are dealing with some dirty diamond dealings. She has received illegal income. There it is in the first line. But this has been tipped off to a SARS official and they are now investigating the matter. You are required as an investigator to look at Mrs. Scaly's sales amounting to 700,000 rands worth of gross income. You're also required to look at an amount that she paid to a police officer to keep quiet about her illegal diamond business. This constitutes an illegal activity in terms of the Prevention and Combating of Corrupt Activities Act 2004. Now we go to the required portion of the question, and they are asking you to discuss the income and whether it is taxable in Mrs. Scaly's hands for 8 marks. They're not looking for a yes or no. You're going to have to substantiate your answer with reference to legislation and relevant case law. You're also going to have to look at the deductibility of the payment made to the police officer, whether that can reduce the extent of the tax that is imposed. Right, so let's get on now and go to the solution. Starting off with the illegal receipts. The question is, does that fit within the definition of gross income? So you have to quickly summarize the gross income provision. That's the total amount in cash or otherwise received by or accrued to in favor of such resident during the year of assessment, excluding receipts of a capital nature. Try and get that down as quickly as possible. It's using a lot of writing time, but you could score a mark for that. Then we say this is not an issue of accrual. She has received the money, so we can move on from there. The question is rather, is it of a capital nature? And we have to say, yes, she has received the amount, and when it is received for your own behalf or benefit, then we have income, in spite of the fact that it might be an illegal receipt. That's the conclusion, really. What we have to have a look at and say, are there any cases that can help substantiate this decision? And that's where we can have a look at several conflicting judgments, including the Delaware Bay Cigarette Company. You should be able to remember that and score the bonus mark if you can get down that no account must be taken of the fact that the activity was illegal, immoral or ultra vires. There is also the more recent decision of MP Finance Group CC that would also score you some extra marks. But really what we are saying is that it is Mrs. Scaly's intention to receive the money for her own benefit, and consequently it will constitute gross income and be taxable during the 2013 year of assessment. You will also notice from the solution that there are other court decisions that have dealt with these matters and come to other conclusions. Obviously, if those are put in, such as COT versus G or ITC 1624, then you would score additional marks. When we go to the deductibility of the payment, what is important is that you get down the deduction would have to be made in terms of Section 11A of the Income Tax Act, and it would also have to pass the tests in terms of Section 23G. The expenditure has been incurred, there's no doubt about that, and it's no doubt that it is in the production of the income, and it's also not of a capital nature, so it meets all of those requirements. The important thing to demonstrate is that you have passed Section 11A, but one also has to go to the negative tests that are contained in Section 23. In particular, Section 23O specifically deducts prohibits the deduction of any expenditure of corrupt activities in terms of the Prevention and Corrupting Activities Act. So that's why they put it in the question, so that it gives you the answer. Notice there was quite a few marks for just going through that. Let's move on to part B. What have we got in part B? We've got a divorce case and a primary residence case. So immediately we know that we are dealing with the issues of transferring a primary residence from one party to another. Transfer took place in April 2012. That will be relevant for determining the extent of the primary residence allowance. The couple were married in community of property. That would be relevant if we were dealing with interest. It, however, does not have an impact as far as the capital gains tax consequences of this transaction. Then we get the question of the acquisition price, and then in addition to that we have improvements. However, what we see in the improvements is that there has been one improvement which has subsequently been demolished, and then a further improvement that has been made at a subsequent date. Then they give the market value of the residence at the date of the transaction. We get further facts that Mrs. Blake couldn't deal with the divorce and she put the property on the market. In the meantime, she vacated the premises, and that is relevant because it has a capital gains tax consequence with regard to the primary residence allowance. And then they give you the selling price, ultimate selling price, together with the agent's commission, which is a selling expense. The requirement is a calculation of the capital gains tax implications, which is supported by motivation for your reasons for your calculations. Then we must assume that there are no other disposals that have been made during the year of assessment. That would mean that we can get the full annual exemption, etc. When we go to the suggested solution, we must first of all, for 2 marks, score the marks on the transfer from husband to wife, and recognizing that there is rollover relief in terms of paragraph 67 of the 8th schedule. That's an easy 2 marks. It gets a little bit more difficult when we get to the proceeds of disposal of the property by Mrs. Blake. We record the proceeds and we score a mark. At least you're on the board for that. But we then have to make the point that as we have exceeded the 2 million rand consideration, we now have to do a CGT computation. We look at the base cost, that's the acquisition price. Then there's a couple of little nasties there. There's the 15,000 rand for the second garage. The first garage doesn't qualify because it was demolished. And then we can also add in the estate agent selling cost. That would give you the capital gain. Right. Then we carry on and we say, right, the capital gain is then subject to the primary residence allowance. We will still get the primary residence allowance even though the property has been vacated prior to sale, because you are allowed to vacate the property for a period not exceeding 2 years prior to sale. That's a little special sniper which is carried in paragraph 48 of the 8th schedule. The primary residence exclusion is then granted. There's a 2 million potential allowance, but it is limited to the extent of the capital gain. And finally, there is a conclusion that no capital gains tax is payable. For all that, there's 10 marks. You should score at least 8 of them. Now we move on to part C. Property Wealth is a company with a June year end. It is a developer and owner of commercial buildings, shopping centers, etc. A favorite item for examination is to look at long-term lease agreements. They're always more than 25 years in a question because the allowances are calculated over a maximum period of 25 years. And we have rented this property out to a business in the paper recycling industry, and it's part of an industrial park, and the agreement came into immediate effect. Further information, in terms of the contract, there is a lease premium. When we look at lease premiums, they're generally signed at the time of entering into the lease and paid. Then there is a monthly rental, and then there is always the question of a lease improvement. Notice in nearly every question that you get a lease improvement amount in terms of the contract, which is generally exceeded, as in this case the total cost was 11 million before the building was brought into use. We can assume that there are no accounting entries, and then they give you the taxable income of property wealth at 18.5 million and the taxable income of Green Team at 9 million. So we know then what's going to come in the requirement. They are going to want a calculation of the tax effects of the agreement for both the lessor and the lessee. Notice that you can ignore special allowances under section 11H. Look at that, there's 12 marks in there. You can't go past it because we simply don't like lease agreements. We've got to make an attempt to score as many marks as possible. And that's quite simple. Passing on to the solution, we start off with the lessor, that's property wealth. We take down their taxable income, then we deal with the lease premium. A lease premium is fully taxable in the year that it is received, and so are the monthly rentals. Then we note that paragraph H of the definition of gross income says that a leasehold improvement, even though it's not a cash payment, is fully taxable, and then the lessor will get an industrial buildings allowance based on 5% of the value of the improvement per the contract, which was 10 million, so that 5% of that is 500,000 rand. You should be able to score at least half of those marks. We then move across to the Green Team, that is the lessee in this case, and notice we score a point for just even writing down that there's 9 months of rental. Gets a little bit more complicated when we get to the lease premium. Lease premiums are amortized over the period of the lease, but that can't exceed 25 years, and there were only 9 months in the current year of assessment. But put that all together and we've got 2 marks. The lease improvements, the lease improvement allowance, remember, is always a question of what is contained in the lease. Again, a maximum period of 25 years, and in this case there was only 1 month where it was used. Finally, at the bottom we say the amount in excess of the lease improvement qualifies for a building allowance in terms of section 13.1, so we can take 1 million rand, that's the 11 million spent versus the 10 million contracted, and we can take a 5% allowance on that. Add it all up and you've got 12 marks. Part D is slightly shorter. It should be quite easy, this one. It's a pretty simple concept. They are saying we have a company. It has tremendous growth. It hasn't got enough space, so it then goes out and acquires a piece of land in an adjoining office block. It's using the land for parking. It hasn't made any improvements. They have signed an agreement and they've bought the land only for 300,000 rand. Notice there's no question of improvements in this one. We go to required. Here they're asking for advice with regard to income tax deductibility. And again, you must be able to substantiate your answers, giving reasons and reference to relevant case law decisions. We go to the suggested solution. Again, we've got to have a preamble which says we can only get a deduction if the requirements of the general deduction formula have been satisfied. And then we summarize that out, that we're looking for expenditure incurred. Obviously that's the case. Is it in the production of the income? Well, obviously yes it is. The thorny issue is whether it is of a capital nature and expended for purposes of trade. So we then go through that and we very briefly show that we have satisfied all of those requirements, leaving us at the end of the day with the crisp issue at hand is whether the amount constitutes capital or revenue expenditure. And we always then make the statement of fact that we have to look into what is the purpose of the expenditure. If it is for the purposes of acquiring a capital asset, well then that's part of the capital of the business and the income earning structure. It's not deductible. On the other hand, if it's part of the income earning operations, then it's revenue expense and you can claim a deduction. And you can quote, in that case, New State Areas principles. That's the general principle with regard to capital and revenue cases. The solution goes on and says you can also argue along the lines of whether we've got fixed or floating capital. Again, this is reference to old cases. The part of the solution I like is the enduring benefit test, which is contained in cases like Palabora mining, which shows that if there is a benefit which endures for more than, say, 1 year, then that's long-term capital expenditure which cannot be deducted. So what we see in this case is quite obviously we have got an expense of a capital nature, and this is part of the income earning structure of the business, and accordingly it does not meet the general deduction formula and it is not tax deductible. You should be able to pass that one. Part E to this question, notice very short, you've only got 6 minutes to work on it. They are saying, is interest borrowed on money to acquire shares in the stock exchange deductible for tax purposes? Now, you mustn't write a thesis in this one, because the requirement is we want some simple advice, we want a substantiation, but remember, you've only got 6 minutes to do it. So we get writing, and again we introduce the general deduction formula and say that has to be satisfied. And what we have to then turn around and say is interest is an expense which is actually incurred, and interest is inherently not of a capital nature, and therefore we're okay so far. The question is rather, is interest incurred in the production of the income? And then you can dive into the definition of income contained in section 1 of the Act, and what we see in this is that the expenditure is incurred to produce dividends which are exempt from tax, and therefore the expenditure is not incurred in the production of income. A simpler example is to go to section 23F, which specifically prohibits the deduction of expenditure that does not produce income as defined. Again, the important thing that you've got to watch out for in Part E is that they are looking for a concise answer for only 6 marks. The danger is that you'll waffle off for 15 minutes and get behind time and not get to the bigger marks, which might be contained, for example, in F. Cellucom has trade creditors, and the next word that you're looking for in that is that they have entered into a compromise with the creditor and they have paid less than the initial amount. So we know from that that the next thing that's going to come up, as always does happen when we are dealing with compromises, is that there is the question of an assessed loss, and we know what the question's going to ask you in this. They say there's an assessed loss, there's an amount of a compromise during the year of assessment, what's the tax implication? When you go into the tax implications, you go, first of all, calculate the benefit from the waiver of the loan as if it was a revenue expense, and then for 3 marks extra, they say, what happens if it wasn't a trade debt? Remember, there is a different tax consequence to both. Now, the solution that you have got in this case is based on the old principles which were contained in 84M 12.5 and paragraph 21A2. We can review these principles in the solution, but please note that with effect from 1 January 2013, these provisions have been rewritten and are now contained in Section 19 of the Income Tax Act for the revenue consequences and paragraph 12A of the 8th schedule for the capital gains tax consequences. The old way of dealing with this was to go back into the Louis-Zinn principles, etc., and we say we have a compromise benefit which must first be set off against the assessed loss, and then thereafter Section 8M will then cause a recoupment. So we start off with taxable income before the compromise, we apply the assessed loss brought forward to get an assessed loss which is available to be utilized against the compromise benefit. We then have the compromise that reduces the assessed loss to nil, and the remainder of the compromise benefit then reflects an 84M recoupment. resulting in taxable income. In part 2 of the solution, we look at it if we have the waiver of a loan as opposed to a business debt. That is a capital loan if you want. That used to be dealt with in paragraph 12.5 of the 8th schedule. It's now dealt with in paragraph 12A, and there again it shows the compromise and the capital gains tax consequences of it. What is important to note is that the new 12A can reduce an assessed loss, but it cannot create taxable income. So this last little aspect of the solution will have to be updated for the 2013 year of assessment and the amendments that follow.